Okay, very good morning to everyone. Welcome to the briefing for Friday the 8th of July. So 2 weeks on from Brexit and a month on then from when we saw that shocking payrolls report of 38,000, and we'll be looking out for the latest reading to come in a few hours' time. As per normal, just be aware that it's going to be pretty quiet this morning. It's always the case in the run-up to the key jobs data. So it's always a case of more so just making sure you don't get drawn into something unnecessarily and just keeping your ammunition ready for later on, when undoubtedly we'll get the bulk of the price action for the day are centered around that 130 release. A quick look though on where things stand at the moment. I think one of the bigger outright moves that we had yesterday was crude. Obviously we saw at 330 a big push lower. Certainly the gains that we saw on the back of the APIs, which were bullish, that was quickly paired and more on the back of that move as we broke through some significant handles on the downside, and that also did weigh slightly on the US equity market. Again, it does go to show the kind of learning about the positioning of the market. We were talking about this yesterday. There's a lot of kind of negative macro factors out there, but crude, after being supported yesterday, was up around 50-60 cents through most of the European morning going into that release. That was one of the factors helping prop up the market at the time. So when that data came out, and although it was a drawdown, again, nothing to the size or the tune of what we saw in the APIs, and hence we got that big push lower. Looking technically at this, I know this is something Bill was looking at yesterday, was that kind of late April, early May area of resistance that we had around the $46 handle. So that was around here. And then we managed to finally break above that, and that's when we saw that brief move for a couple of days around the $50 handle. And then we've seen support around 46 come into play around the 16th, 17th of June. Had a quick test on the 27th before a bounce. The key point here then being is that we've now seen a bit more of a larger break of that key $46 handle. So now, technically speaking, are we now on the path to potentially a further move to the downside? And if that did occur, then obviously I'd be keeping a close eye on the correlations with equities as a potential weight if crude did move lower in that way. A quick look at the S&P. This morning we're seeing slightly higher. Again, news flow, there's not really been a great deal going on at the moment. As I say, the market's kind of wait and see mode for the moment. Technically on the day for where we stand at the moment, we're kind of confined by the range of R1 and S1, which kind of encapsulates much of the highs and lows from yesterday's session. On a slightly longer dated, again, still, and when payrolls hits, it's going to be these upward levels. Should it be a stellar number at the 2100 handle, and then 2104 and 3/4, the kind of July high that we'll be eyeing on the upside as key levels. Quick look at cable. Again, continues to be one of the main headlines that you see in various publications at the moment. Again, looking here on a 120-minute candles, you can see we're pretty much stuck in this newly defined kind of range, if you like, between around 128 and then 130.50 type levels. Don't really see that going anywhere substantial for the time being, certainly next few hours, until we see what the dollar moves are like on the back of the Fed or the NFP report. So a quick recap of the actual news flow then. There's a couple of things that have come out, and first kind of table just to share with you is this one. Consumer jitters. This is a UK GfK consumer confidence reading that's come out overnight for the UK, and no surprise then to see consumer confidence getting a severe hit on the back of Brexit. But you're starting to see a bit of a combination now of business-related surveys also deteriorating. But if the consumer outlook also goes sour, then you're kind of getting hit on all sides of the economy then. And that's not a good sign in terms of the potential growth rate of the economy. You can see here, the lowest now since 1994. So when you hear the likes of Andrea Leadsom saying that everything is fine, look at the FTSE 100, and this is a lady who apparently was a fund manager and worked in the city all her life. I'm not sure what side of the bed she got out of yesterday. The other things that we have seen then is on that front, Theresa May and Leadsom then will now go head to head, having, thank goodness, Michael Gove being eliminated out of the leadership contest. Keep in mind though, from a timing point of view, really this news is insignificant from a market moving or market impact point of view. The two candidates are in the final runoff, Leadsom and May. They are the clear kind of two main candidates, and Theresa May is still the outright favourite. We're not actually going to get the results then of the Tory membership vote until September. Don't forget, I think there's around 150,000 Conservative members that have to now place their vote on who they want. So not expecting that to really be, although you'll read about it, it's the main kind of, I guess, broadsheet headline, but it's not really a market moving event for the time being. What will be more interesting is comments and data we get in the coming weeks about how the economy's fared post-Brexit. Elsewhere, quite an interesting comment out of China overnight. So, an interest rate cut cannot be ruled out if China's second quarter economic growth misses expectations. That was according to researchers from a government-affiliated institute called the NDRC overnight in the Shanghai Security News. Next week is when we get that GDP reading from China. It will be interesting to see then what their response will be, given the fact that their currency has been falling again at a 5-year or 6-year low. I think it's trading at the moment. So these are other factors as well, and a more broader macro picture to be aware of, because things have gone a little bit quiet on the Chinese side of late. But certainly if they look to cut rates, then you've kind of then got globally not only the likes of the ECB, the Bank of England, very much likely to do more. I think from a Bank of England perspective, it's now priced in next week around a 75% probability of a rate cut, and rates certainly a prospect of going back to zero and further QE in August. Expansionary policies out of the ECB, and if China starts cutting rates as well, then all of a sudden, is this from a central banking point of view a long opportunity for equities and gold, from the prospect that they're doing quite literally whatever it takes to support the economy, irrespective of some of the other ongoing uncertainties such as Brexit and the Italian banks and so forth. We've had some German trade data as well this morning. More interesting was the exports posting their steepest monthly drop in 9 months. Again, the export number month to month was 0, expected was for plus 0.4%. Now, if you think about this week, from let's say the engine room of Europe, you've had disappointing industrial production, weaker factory orders, and now you've got exports posting their steepest monthly drop in 9 months. The kind of worries and concerns at the moment are still very much centred around the periphery, but if things start taking a bit of a nosedive from a German perspective and their economic output, certainly things then start to get a new level of urgency potentially for the ECB to act. So, main event, let's have a quick look at non-farm payrolls. If you remember quite rightly, last month, actually, even though it was, I think it was expected at 160, if I remember correctly, the bottom end of the analyst range was 90, and of course it came out at 38,000. That was coupled with downward revisions to the previous, downward revision to the 2-month net, revision. The wage data was pretty much in line, but other components were also weak. And that actually provided probably more of a simple strategy to execute, given the number was so far out of expectations. We saw a very strong move in the market. Now looking firstly at where that number lies in terms of a historical point of view. Obviously we got closer around those levels back in late 2013, but you're talking about levels not seen since 2010, 2011 type era, and obviously this is coming on the back of the recovery out of the subprime crisis. So these are extremely depressed levels. But looking at it on a slightly different metric, this is something I think we've shared with you guys before, but this is kind of an updated version of. So this is Danske Bank's kind of spider web labour market in one chart. And just explaining what it is that you're looking at. So you've got 4 kind of main colours and lines here, and you've got the key at the top. Now the red line, i.e. the centre, is the height of the financial crisis. If you remember the collapse at the end of 2009, or that era of Lehman Brothers and the height of the crisis, this was when we were at the worst point, if you like. The blue line, the next kind of perfect circle there, you can see that was pre-crisis, and where all these different metrics that you would look at from an employment perspective, where we were sitting. And then it's the orange line really that we're focusing on, which is the most recent reading of 2016, and even comparative on a year-on-year basis from where we were last year. You can see that the situation overall, from temporary help wanted, particularly the amount of job openings that are available, payroll, employment, initial claims, certainly, we are at arguably a much stronger position than we've been in a long time. Yeah, there's other contemplations as well to take into account with the payrolls reading, particularly with this time round, is we've had ADP, employment change, yesterday came in higher than expected, very minimal revisions on the previous. So overall, that helped the market from an equity perspective, and that's helped cement expectations of a fairly, I wouldn't say decent, but a reasonable number today. Initial jobless claims continue to remain supportive. The 4-week average is 265,000. That's the lowest now since April. And also, one of the big contributing factors to the weakness of last month's report was the fact that there was roughly around 35,000 Verizon workers striking. Now, if you're to look at some of the bank calls for what they're expecting, on the top end of analyst estimates on the street is Goldman Sachs. Consensus estimate today for non-farms, I believe, is 180,000. Goldman's are going for 210. In part, the pickup reflects, in their opinion, the conclusion of a strike at Verizon. This alone, they say, accounts for 70,000 of the month-over-month swing. However, they also see scope for improvement beyond Verizon, as labour market data has generally looked encouraging. So you've got low jobless claims, you've got a forecast beating ADP, you've got fairly decent ISM employment components as well. All of these in the run-up would indicate to me that we're on course on those metrics for a fairly solid number today. That means then, if the market's prepped for a fairly solid number, from a trading point of view, what I'm looking for a more larger, cleaner, outright sharp move in prices is if we get another disaster. We get another 50k type print, then you're going to see some serious movement in the market. Likelihood, initial reaction to that scenario, weakness in equities, bid in treasuries, and weakness in the US dollar. But again, we'll talk about this a bit more closely as we get closer towards the time of release. A quick look though, in summary, of what some of the other banks are looking at. Again, consensus for non-farms is 180. So you've got Goldman's top end at 210. You've got Barclays at 175. And then, we talk about Deutsche Bank quite a lot. Deutsche Bank have been pretty accurate, actually, of calling non-farms because they've tended to be one of the more bearish calls on Wall Street, and they've got it right the last certainly 2 months. They kind of encapsulate it. They're going for, again, below consensus, they're going for 155. Now the big question, the big question they say would be whether this means full employment is approaching and higher wages around the corner, or whether it reflects companies scaling down hiring as profit margins get squeezed. They tend to sit with the latter view. So again, it's going to be interesting whenever there's a large divergence on the street. That would only suggest to me then that there's a high degree of sensitivity to the number today, but certainly from a market positioning point of view, I would say we're more leaning on the prospect of a better number. At least that's how the markets are sitting at the moment. Okay, otherwise, a quick look through the calendar for today. That's pretty much it, really. We've got UK trade balance at 9:30, but that is not going to be too much of an impact for sterling currency. Then from a sovereign rating perspective, just so you're aware, you do have S&P. It's a scheduled update they're due to issue on Germany, but more importantly Europe. Be quite interesting to see. DBRS, they're slightly, I would say they're the fourth strung rating agency globally, and they're going to be issuing an update on the UK. These normally come well after market close. Not market moving, so to speak, but just interesting to see their commentary and assessment on the credit conditions of the UK post-Brexit. Okay, just to wrap things up then, just taking a quick look at the S&P here. I've just noticed in the corner of my eye we're starting to see a little bit of movement to the upside. And I guess you've got the psychological kind of levels of 2100. I can't really see that being tested or broken at this point, not ahead of the jobs data. But if you start to get any further upward moves in the equity markets here, likely to add to just some, I would say, slight moderate risk on theme. So a bit of dollar weakness at the moment, that's helping lift crude as well after those depressed levels yesterday. So WTI is up around 40 cents, and just seeing cable recover some of lost ground this morning. Okay guys, that's the briefing for this morning. I'll do a more thorough look at non-farms a bit later ahead of the release. But have a good trading day.